What did you make of this latest trade number coming out of China? Clearly, the path to stabilization still showing a question mark at the end of the sentence, right?
Morning, Dan. Yes, I mean, it's good news that China exports were better than expected, minus 8.8 against minus 9.2. That's obviously a positive message. But actually, there's quite a few factors that we're looking at around China that make us still very cautious and slightly nervous. And GDP growth in China is still only 0.8% quarter on quarter. It's down from 2.2% in Q1. You've seen youth unemployment hit its highest level on record in China. You've seen the currency at its weakest level in nearly 16 years. So there's lots of other issues in China still. So we think while the export number is good, it might be a flash in the pan. It's only one data point, and we think you still have to watch very closely to see how this recovery pans out.
And your broad view over at Hassium is that equities are going to struggle over the next 12 months. No doubt the concerns in China also feeding into that narrative. But broadly, can you give me a sentiment check on where markets stand right now and where you see sentiment and market direction trending towards the end of the year?
Yeah, so we are pretty cautious on equities. You're right, Dan. Valuations are reasonable aside from US tech. So we think you have to be very careful about having a large exposure to the US tech sector. PEs are around 20 times earnings across the US and about 35 times in US tech stocks. So it's important to ensure your sector exposure is in line with where you'd like it to be at the moment, especially in the US. But aside from that, valuations do look quite fair. In Europe, the PEs are 12 times. In the UK, they're 10 times. So while we are cautious, we do think you need to be invested in this market. Equities don't look crazy expensive. And actually, fixed income markets are looking really compelling. Short-term corporate bonds and government bonds, you can get 5 or 6% yields on 2-year securities and over 4% in 10 years. So they're good investments out there. It's just being more selective and being more active in how you're allocating across portfolios right now.
What about when it comes to Fed policy? You mentioned some of the returns we're seeing across treasuries. Treasuries actually lifting higher across the curve as we speak off the back of the latest ISM number, which has raised bets for more Fed tightening. But there's also a broad view out there that we have hit a peak in rates. What's your view?
Yeah, we don't think there's going to be more interest rate tightening from the Fed. We think you're at peak levels right now. Although our view that's slightly different from the market is the market's expecting 3 to 4 cuts in 2024, we actually think it's very unlikely there'll be many cuts, if any, in the US in the next calendar year. We think the Fed's likely to pause and stay at these levels and wait for inflation to stabilize below 3%. And actually, right now we're at 3.2. That's a slight tick higher from 3% in the previous reading. And expectations are for 3.4% in the next month's inflation read. So we think the Fed are going to pause until inflation stabilizes below 3, or they see evidence of a recession and they pull back on tightening and start to loosen monetary policy.